Using candlestick analysis, it's very easy to observe the obvious. The obvious is if you start getting sell signals that bring you back down through the T line, which has been acting as your trend support for most of this uptrend, it also allows you to kind of project where your pullback may lead or go to. Where do you think everybody was watching to see what the pullback was? Probably the 50-day moving average. What do we see as candlestick investors? We see bullish Harami hammer type signals when stochastics are getting near the oversold area. Confirmation that the 50-day moving average is going to hold would be merely a positive open on the next trading day, which means now we watch to see what it does once it gets back up to the T-line. If it fails at that level, any long positions that don't look strong, you close them out, because that probably means you're in a downtrend, but you're being squeezed in between the T-line and the 50. On the other hand, a lower open and start trading back down tells us this downtrending channel is still in effect, that you don't want to be adding long positions. You want to continue to hold your short positions until you see a buy signal confirmed. Another major advantage to candlestick analysis is that it identifies patterns that have a high probability of moving in the direction of what the patterns say it's going to move. Today, as we saw in the Dow, it didn't have a very strong day most of the day, but BEBE had a doji, fry pan bottom, breakout, and we know the simple rule of a doji. It's going to move in the direction of how they open it after a doji. In this case, they moved up positive, taking us into wave 3. You continue to stay long now as long as it doesn't close back below the T-line. Knowing what should occur in a trend and what a reversal signal looks like is a huge advantage for any investor. For example, notice how the bearish Harami at the top took DDD down below the T-line. We're still below the T-line, but we've had a positive trading day. However, in Japanese candlestick analysis, this is just an up day in a downtrend. It's not a signal. Plus, your stochastics are still in a slow downward trend, so this would put us at a little bit of a warning to say we might not want to go long unless we definitely see it break through the T-line. We wouldn't want to be buying today because we're still below the T-line, stochastics are still heading down, and we haven't had a reversal signal. Those are all things that keep people or keep investors from jumping in too early, because if they open this lower and start taking it right back down because they failed at the T-line, you still want to be not buying this position. So candlestick analysis not only tells you when to buy and get into a position, it also tells you when to stay out of a position until you see some sort of confirmation the bulls have taken control. That'll be it. We'll see you in the chat rooms.